Subprime mortgages fueled the Great Recession starting in 2007. Subprime mortgages were loans extended to borrowers with poor credit histories who typically had difficulty obtaining conventional financing. The financial sector rationalized these risky loans by assuming that home prices would continue to rise indefinitely, which minimized perceived default risks at the time. Imagine you lend money to someone who can barely pay their rent. That's what happened in the housing market from 2005 to 2007. By 2008, millions of people were defaulting on their mortgages, particularly those with subprime loans. This caused a domino effect. Banks lost huge amounts of money and stopped lending, leading to a severe credit crunch that contributed to the Great Recession. Now let's talk about how this happened. In the mid-2000s, housing prices were rising significantly. People believed homes would always increase in value. Banks saw an opportunity to make more money by giving loans to a broader range of borrowers, including those with lower credit scores. These loans often had low initial payments that reset to higher amounts after 2 or 3 years, known as adjustable-rate mortgages, ARMs. Banks packaged these risky subprime mortgages into complex financial products known as mortgage-backed securities and sold them to investors globally. This created an illusion that everyone was profiting from the housing market boom. But in reality, this prosperity was unsustainable and based on unstable fundamentals. The problem was that banks did not adequately verify whether borrowers could repay their loans. Instead, they heavily relied on the assumption that continually rising home prices would ensure profits or mitigate potential losses. When housing prices began to decline in 2007, many homeowners found themselves unable to refinance or sell at a profit, leading to an increase in mortgage defaults and foreclosures. This led to the Great Recession of 2007 to 2009. Banks halted lending due to fears of further losses from subprime mortgage defaults. Without loans, businesses found it difficult to maintain operations and invest in growth. As a result, unemployment rose sharply and economic activity declined significantly. Let's break down how this affected everyday Americans. In 2008, homeowners defaulted on $168 billion in mortgage payments. By early 2009, home prices had dropped by about 30% from their peak in the second quarter of 2006. People lost their homes and life savings. For example, a family that put all their money into buying a house at the height of the bubble suddenly found themselves owing more than their property was worth. The impact was significant. Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy in September 2008. This event triggered widespread panic and uncertainty across global financial markets. Other major banks, such as Citigroup and Bank of America, required government assistance to remain solvent. But why did this crisis happen? It wasn't just risky loans or greedy bankers. There were systemic issues in how our financial system operates. One issue was the reliance on complex derivatives, which are financial instruments that derive their value from other assets. When those underlying assets lost value, it triggered a chain reaction throughout the market, leading to widespread collapse. Another issue was lack of regulation. In 2000, the Gramm-Leach-Bliley Act repealed significant portions of the Glass-Steagall Act, allowing commercial banks to engage in investment banking activities and insurance sales. This meant riskier investments could mix with everyday savings accounts, exposing ordinary Americans to more financial risks without proper safeguards. Now let's talk about how this affected the economy as a whole. The U.S. gross domestic product, GDP, dropped by almost 9% in the fourth quarter of 2008 and first quarter of 2009. This was one of the steepest declines since the Great Depression. Unemployment skyrocketed. By the summer of 2009, unemployment rates peaked at nearly 10%, with millions of people unemployed for extended periods. Many lost their homes and savings as banks foreclosed on subprime mortgages in large numbers. The government responded by implementing measures like TARP, Troubled Asset Relief Program, to inject capital into the financial system, which aimed to stabilize banks and restore liquidity in credit markets. This initiative helped prevent a complete collapse of the banking sector, but also raised concerns among taxpayers about the use of public funds to support large corporations. So what can we learn from this? The subprime mortgage crisis demonstrated that unchecked risk-taking in finance can have disastrous consequences for everyone. It's crucial to understand how interconnected our financial systems are and the importance of regulations to protect consumers and prevent another economic downturn. Let's look at some concrete examples. Take a family who bought a house in 2006 when prices were high, thinking it was an investment. By 2008, their home value might have dropped significantly, but not necessarily by half for the average homeowner. They couldn't afford the higher mortgage payments and faced foreclosure or default, potentially losing their home. This isn't just about abstract numbers, it's about real people losing their homes and livelihoods. The impact on families, communities, and the economy was profound. Now, let's talk about how this crisis reshaped our financial landscape. After 2008, there were stricter regulations like the Dodd-Frank Wall Street Reform and Consumer Protection Act to prevent future meltdowns. This included measures such as stress tests for banks, limits on risk-taking activities, and increased oversight of derivatives trading. But the legacy of the Great Recession, which lasted from December 2007 to June 2009, is still with us today. Millions of people lost their homes and savings during this period. Trust in financial institutions plummeted as a result of the subprime mortgage crisis. The recovery was slow, and many Americans are still feeling its effects years later. The housing market took about 5 years to begin recovering from the Great Recession, with home prices returning to pre-crisis levels by around 2013 in some areas and later in others. Not everyone benefited equally. Many homeowners who lost their homes during the crisis were unable to regain the same level of wealth they once had. Now let's look at how the Great Recession and the subprime mortgage crisis changed consumer behavior and expectations. People became more cautious with spending and saving. They focused on building emergency funds and avoiding risky investments. The idea that homeownership is a guaranteed path to wealth was significantly challenged for many. The subprime mortgage crisis of 2007 to 2008 highlighted the importance of financial literacy. Understanding risks, reading contract terms carefully, and managing personal finances became crucial for everyone, not just experts. This brings us back to the core question. How did the Great Recession start with risky subprime mortgages and end up impacting millions? It's about understanding how complex systems can fail when there are no checks in place. The lessons from 2007 to 2009 teach us that financial stability requires vigilance, transparency, and a strong regulatory framework. The subprime mortgage crisis, which began in 2007 and led to the Great Recession starting in late 2007 and lasting through mid-2009, was more than just bad lending practices. It exposed deep flaws in our financial system. This period revealed how easily trust can be shattered when greed overcomes responsibility. This is educational and historical, not financial advice. Let's dive deeper into how risky loans contributed to turning the housing bubble into a global economic crisis during the Great Recession. At its core, the subprime mortgage crisis was fueled by an intricate web of interconnected players, including mortgage brokers, investment banks, rating agencies, and regulators. Mortgage brokers were incentivized to push borrowers toward riskier mortgages that came with higher fees and interest rates. These loans often didn't require substantial down payments or proof of income, leading many people to take on debts they couldn't realistically repay. This dynamic was a key factor in the buildup to what became known as the subprime mortgage crisis, which contributed significantly to the Great Recession that began in 2007 and lasted until 2009. Investment banks packaged subprime mortgages into complex financial instruments known as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These securities were sold to investors worldwide, promising high returns despite the underlying risky nature of the loans. The issue was that these investments lacked transparency, making it challenging for investors to accurately assess their risk levels. Rating agencies played a critical role by giving these risky securities high ratings, which further fueled demand from unsuspecting buyers. Investors poured money into these products because they believed the ratings assured low risk. In reality, rating agencies had conflicts of interest, as their revenue depended on fees paid by the firms issuing these securities. Regulators and oversight bodies also failed to keep pace with the rapid evolution of financial instruments. Many argued that traditional mortgage lending rules didn't apply to complex derivatives, leading to a regulatory gap where no one was adequately monitoring these new financial products. This lack of oversight allowed the housing market to inflate dramatically until it burst catastrophically in 2007 and 2008, triggering the Great Recession. So how did this all come crashing down? As home prices started to fall and interest rates rose, many subprime borrowers couldn't afford their monthly payments anymore, leading to a surge in defaults. This triggered a domino effect through the financial system. The value of mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were based on these risky mortgages, plummeted as investors realized they had been sold assets that were riskier than advertised. The financial crisis of 2007 to 2009, often referred to as the Great Recession, highlighted the importance of transparency and accountability in preventing systemic failures in the financial system. Financial institutions must be held responsible for their actions, and consumers need better information about the risks associated with financial products. Subject: the Great Recession and the subprime mortgage crisis. Think about this. When banks and investment firms could package high-risk subprime mortgages into complex securities, it created a false sense of security among investors worldwide. This misalignment between perceived risk and actual risk is at the heart of what went wrong. One concrete example to illustrate this point. During the peak years of subprime lending 2006 to 2007, over 20% of all mortgages originated in the United States were subprime loans. These risky loans formed a significant portion of the mortgage-backed securities sold globally. When defaults began to rise, it quickly became evident that these supposedly safe investments were anything but. Another critical lesson from the Great Recession and the subprime mortgage crisis is the importance of having robust financial regulations. These events revealed systemic weaknesses and regulatory blind spots that permitted excessive risk-taking, leading to significant market instability. Stricter oversight could have potentially prevented many of the risky practices that contributed to this economic downturn. In short, the Great Recession was not just about individual borrowers taking on too much debt. It was also about systemic failures due to a lack of transparency, accountability, and regulatory oversight. This highlights the importance of understanding these risks and advocating for stronger financial safeguards in our economy. This is educational and historical, not financial advice. The housing market collapse during the Great Recession had severe consequences for homeowners across the country. Many who took out subprime mortgages found themselves underwater, owing more on their homes than they were worth. This led to a wave of foreclosures that devastated neighborhoods and communities. Another major player in the subprime mortgage crisis was the credit rating agencies like Moody's and Standard & Poor's. These agencies assigned high ratings to risky mortgage-backed securities, which misled investors about the true risk level. Their actions contributed significantly to financial instability by enabling the widespread sale of these toxic assets. The ripple effects were felt globally as well. Banks and financial institutions worldwide held trillions of dollars worth of mortgage-backed securities backed by U.S. subprime mortgages. When the U.S. housing market crashed in 2007 to 2008, it triggered a global credit crunch, leading to liquidity issues in international markets and triggering recessions in other economies. Moreover, the Great Recession highlighted the interconnectedness of various sectors within an economy. What started as a housing market crisis, fueled by subprime mortgage defaults, quickly spread to other areas, leading to job losses, declines in retirement savings, and increased costs for everyday expenses affecting millions of people. Unchecked risk-taking in finance can cause widespread economic damage. Understanding these dynamics is crucial for preventing similar crises in the future. This is educational and historical, not financial advice.